Friends, I have been making videos around stock market, stock trading, and various other tutorials for a while. And I have realized that most people who ask me questions in my comments section do not understand how really the stock market works. So let me make a very basic explainer video on how does the stock market work, but I'll make it practical. I want you to understand basic things like what is the difference between trigger and price. I want you to understand why the opening price on a certain day could be different from the closing price of the previous trading day. I want you to understand the concept of liquidity in stock market. Why do upper and lower circuits happen? And why is this T-pin, the new beast which we are seeing, necessary for transactions, especially when you are selling stocks? Why is that happening? So all of this will be answered once you understand the basics of why stock market or how stock market works. Before we move forward, I have one question for you and one request. My question is simple, but my request is that subscribe to this channel, support me. And my question is that do you know who is your depository? If you have a demat account, who is your depository? By the way, demat, if you do not know the meaning of demat, I will be surprised. And do you want me to make videos which explains the meaning of such basic terms as well? So if you do not know the meaning of demat, you can also again comment and tell me. And if you know who your depository is, if you have a demat account, comment and tell me. So why is stock market called a market? Let's first decode that. So let's say our friend over here, let's name this friend Ram, wants to buy 200 shares of a particular company for rupees 50 each. And our friend Shafika here wants to sell 200 shares of this company for rupees 50 each. So they will go to their respective apps, let's call them apps, and place a request, buying in case of Ram and selling in case of Shafika. And they will place their buy and sell request. Both of them have put in the quantities and have put in the rate. Their orders will be matched on an exchange called NSE and BSE. So either on NSE, National Stock Exchange, or Bombay Stock Exchange, their orders will be matched and the money and shares will change hands. So the money will go from Ram to Shafika and the shares will go from Shafika to Ram. That is why it is called a market. When you place an order on NSE and BSE, there is a person just like you on the other end with whom you are trading. You are exchanging something against value. This is why it is called a market. If there is nobody on the other side to sell, you cannot buy. The order will not go through. So it is basically demand and supply. That is what is happening in the market. Now, how does this affect your trades? Let's look at it. The first thing that we need to understand is an order book. Now, this is what an order book looks like for a stock. Now, an order book basically is a sum of all the buy orders and sell orders which have been placed for a particular stock. Now, you will see over here in this chart, the buy orders are in decreasing strength. So, the price which is on the topmost is the highest, and then the price coming next and then next and then next keeps dropping. So the price keeps dropping over here. So right on the top is the highest price, and the sell, you will see, is in the reverse. The lowest price is on the top, and then the price keeps increasing. So this creates a tension in the market, and there is something called a spread. Spread is the difference between these two right on the top. So if you notice, the sell price is at 0.45 paise and the buy price is at 0.40. So there is a 5 paise spread between these two prices, and that is why the order book is maintained. Whenever someone is ready to sell at 40, the trade will execute because this order will be matched, and whenever someone is ready to buy for 45, this order will execute because the sell order is already in place. So buyers and sellers in the market, they place their orders in the order book. Either if they are buying or if they are selling, they say that, hey, I am willing to sell for this price and I am willing to buy for this price. And then in your exchange, say NSE, the order book is maintained and buying selling happens over here by matching hundreds and thousands of orders per second. Now you may wonder, there is also a BSE apart from NSE. So what happens here? So these order books are highly liquid and they are synced. So if a stock is listed on both the exchanges, there are people who will manage the order between both these exchanges and do something called arbitrage, which we will not dwell upon much today. But let's just say that the price difference between NSE and BSE for all practical purposes will be non-existent. There will rarely be a significant and constant price difference between these two exchanges because the market is fluid, or you can say the market is efficient because of arbitrage. Anyway, so once you understand that there is something called an order book where your orders are placed, it will explain a lot. You may say that I want to buy this stock for 1900, but there has to be someone who is willing to sell for 1900. And even if someone says, okay, I will sell for 1900, if there is someone who is willing to buy for more than 1900, the seller will get more price. So what will always happen is the most efficient transaction, the transaction which is at the highest buying price and a selling price which can match this, will go through first. So orders keep matching in this order book at NSE and BSE. Now here is another representation of order book. Generally order books are placed vertically like this on top of each other. So you will see over here all the sell orders are here and they will keep increasing in price going up, and all your buy orders will keep decreasing in price. So the buyers are smart. Buyers are saying this is the maximum I am ready to pay, and then there are buyers who are willing to pay less as you go down. And the sellers, they are also smart. They are saying this is the least I am willing to accept, and then the price keeps going up. That is why there is a downward and upward tension in the market, and orders keep matching in between. Anyone whose order is matched, they go out of the order book. There is also a quantity section over here, as you can see. So quantity of stocks which have been offered for buying and selling are also there. So you may want to buy for 37.38. You may want to buy 20,000 stocks, but only 11,380 is provided currently in the order book, and partial matching of your order may happen, and it may take some time for others to offer your stock at the same price. Now this order book is often open and readable by some people depending on what exchange and what market it is, and people do all sorts of analysis and trading based on the order book. Now how many people are selling at a given price, how many orders are there, and for this reason what may happen that today the market may close for 37.37. Okay, great. But now the market has closed at 3:30 p.m. Now overnight there has been a news about this company which is extremely positive. All of these sellers are going to take away their order and the minimum price tomorrow morning will be 40. As a result, you may think that the market closed for 37.37, so I can come and now buy for 0.38 tomorrow. But your order will not go through because tomorrow the sellers have put in new orders, and only when there is a seller willing to sell at the price that you are asking for can your trade go through. This is why you see something like market opening at a price which is different, often higher or closer than yesterday's price. This is also the reason for something called circuits, that there are a lot of people willing to buy this stock. So they will keep offering more money, but there is absolutely no one willing to sell at that price. This happens if there is something very important happening in that stock. So you may say, instead of 37, I'll buy for 40 rupees. Great. I'll buy for 41. Great. But there is no one willing to sell at that price. This is where NSE and BSE have to apply circuit breakers. That okay, today the demand supply is in a mismatch. We will let the market settle. So at say 5% above yesterday's price, we will not allow any more orders and we will hold the market at that price. So the price can't go up by 100%, 200% in a single day. There is something called circuit breakers, which allows the market to think, take in the information, plan, and then come back the next day. Similarly, if there are a lot of people willing to sell the stock, extremely bad news has come out that okay, I'll sell it for 30 rupees, just take my stock. But there are no buyers, so the price will fall. The circuits again can be 5%, 10%. The limit is set for different category of stocks by SEBI and the exchanges enforce it. So again, depending on demand and supply, prices can also drastically go up and down. There can be something called circuits, which we have heard of. You may or may not have seen it in the market. And these circuits give market time to breathe and take in information and be a little predictable. So that's how an order book works. So again, as I explained, liquidity and news impact the markets. SEBI tries to protect investors to provide a fair and stable market. That is why circuits happen. So what does the whole landscape look like? This is very, very important to understand. So let's not spend too much time, but hey, your depositories, as I had asked you before, are CDSL and NSDL. These are the people with whom your shares are kept. So your shares, they are the custodian of shares in dematerialized format. Demat means dematerialized. You place your orders using apps or brokerages like Zerodha, Paytm Money, Upstocks. In case you do not have a brokerage account yet, please go and click the link in description and open one. In fact, I recommend that you should have at least 2 Demat accounts for different purposes, and I am making another video explaining why that should be so. I will link that video on the top whenever that video is ready. And then these brokerages place your order on an exchange called NSE and BSE. So if Ravi over here sells something, Ravi is instructing Zerodha, take stocks from my CDSL account and sell it on NSE. So CDSL will then send an OTP verification, which we also know as TPIN, to confirm from Ravi, hey Ravi, Zerodha is telling me that you have asked for these stocks to go out in the market. Have you really said so? So your OTP provides CDSL a confirmation. Yes, I have told Zerodha to sell it on NSE, and that's why your stocks can be allowed to go on Zerodha for sales. So the different parts of the market or different parties involved is you, your depository, which could be CDSL or NSDL, the brokerage, wherever you have your account, and the exchange on which the buy and sell is happening. These are the parties involved. Once you understand that these are different parties working together to bring your order into place or facilitate your trading, you will understand a lot of things like trigger and price as well. So let me give you an example of trigger and price with this same diagram and tell you how that happens. You would say that, hey, sell this stock. Say you're putting a stop loss when the market hits 1900 rupees. So the market currently is at 2000. You are saying if the price drops to 1900, please sell my stock. Now the 1900 which you are providing to Zerodha, say if you're using Zerodha for trading, this 1900 is a trigger. Zerodha is holding the order with them. They have not yet sent it to NSE. When should they send it to NSE? When the market price hits 1900. Now when the market price hits 1900, which is your trigger, at what price should Zerodha send it to NSE? Should they send it for 1900 itself? Should they send it for 1899 because the price was falling and that is why it has hit 1900? Or should the price be 1901? Now, a lot of times Zerodha may say that I will send it as a market order. which means that whatever is the market price at that point on NSE, I will sell it. Which means that the price may have fallen further to 1850 also. The trigger happened at 1900, but the price fell very fast and it was 1850 by the time your order was matched. So be it. Or it may go at 1900 itself or 1899.99. Depends. So the market price means whatever is the market price, it will sell at that price. In other times, it will say, hey, set a limit. So you may say sell it for 1899. So the order will go to NSE for 1899 and it will reach the order book at 1899. Then if someone is available to buy at 1899, your order will get matched. Otherwise, it will not get matched. Now you may ask that why can't I sell for 1901? See, if you are putting a stop loss and you want to sell, if the price is falling from say 2000 and has come down to 1900, which means the price has been falling, which means the momentum is downward. 1901 has already passed and the market has now reached 1900. And that is why a lot of times a brokerage may say, hey, your actual price has to be lower than the trigger amount when it's a sell transaction. Now, in case of a stop loss where you are buying, which means you have a short position where you have already sold the stock. Say you sold the stock for 1950 and you are now saying that, hey, if the price is going up, right, I will make a profit when the price goes down. So at 1900 I am making a profit, but if the price starts to go up, what do I do? 1950 is the price, I will make profit below it. Market is going above. So at 1975, I'm saying I can't take any more loss. So when the price is going up at 1975, please sell, and I am okay if the order even goes up at 1976 or at market price, which would likely be anything over this price. So that's how it will work. Now, this is for stop loss. Both of these instances which I have told you are for stop loss. There can also be a target where you want to book a profit. So again, your trigger is at 1900. You want to sell the stock. You are holding it since it was 1000 rupees and you are saying at 1950, I'm okay to book some profit. So you will give a target to Zerodha that, hey, and this order will be placed using something called GTT in most cases. I have a video on GTT which you should see. You will tell Zerodha that, hey, the market is at 1900, but when it reaches 1950, please sell it. And I know that when the market is at 1950, it's better that I put my sell order at 1949 or 1949.9 because this is the highest price known to me at this point. So I will rather sell it a little lower this or at the same price to make sure my order goes through. If I get greedy and say 1951 should be my order, sure, Zerodha will send your order to the order book with NSE. The order will be triggered and goes at 1951 to NSE. But then the order has been triggered and finished and done from Zerodha's side. Then it may or may not match at NSE, and at the end of the trading session, all orders on NSE get cancelled. So NSE will not hold your order for the next day for the price to come. That job was being done by Zerodha for you. And that is why your trigger and the price at which you want to execute the trade has to be managed properly and conservatively, because if it does not match at NSE, Zerodha does not know what you want to do next. It will trigger the order and then forget the command you have given. The fulfillment has to be done by NSE and BSE. So a lot of what happens during GTT, good till triggered orders. Why is it called good till triggered? It is good. It is maintained by Zerodha or Upstocks till it is triggered. And once it is triggered, it's done from their end. They don't know if NSE, BSE will honor the trade. That is dependent on the market situation. They do not take a guarantee for it. Even NSE, BSE can't take guarantee that your trade will be fulfilled because it is demand and supply. This is extremely important. If you have any doubts, please ask me in comments below. So now you know the difference between trigger and price. Now you know why opening price can be different from closing price, because new day, new orders are placed and overnight market sentiments can change. Liquidity means how many buyers and sellers are there in the market for a given stock. which can lead to circuits if there is a mismatch between the two. And now you know why TPIN OTP is necessary, because CDSL or NSDL are your custodians and they need permission to allow your brokerage to sell the stock on the market, which is a protection mechanism for you. What would happen if your brokerage could just take your stock and sell it in the market on your behalf? Wouldn't that be crazy that they can sell your stocks without your permission? To make sure that permission is there, this is the OTP system which we are very familiar with. That's enforced now, and that's why you have this TPIN system from CDSL and NSDL. Should I have covered anything else over here today about stock market basics? Please tell me in comments. I read all your comments and I am very encouraged by them. So please keep them coming. See you next time.